Hello and welcome to the Monday edition of Market Briefing. I'm Martin Bakkerdax, the European business editor here at the IB Times UK. Well, we're looking at global stock markets take a bit of a breather today. They have a lot of risk to contend with, and as a result, investors are just pulling back a little bit across the board. We're seeing marginal declines around the FTSE 100 here in the UK, and indeed around some of the major indices across Europe as well. There's good reason to be concerned. Of course, we have the sequester just getting a foothold in the United States. That's going to be about $85 billion in spending cuts spread out over the next several months, and many economists say if there isn't a deal reached by lawmakers in the United States, that this could turn the UK's fragile recovery, the US's fragile recovery, back into recession. There's also, of course, the continuing political saga in Italy that investors have their eye on. There is some expectation of a new vote as a result of the leaders being unable to reach an agreement on who should be the next prime minister of Europe's third largest economy, and indeed in China as well, where authorities of the new regime are planning a crackdown on property speculation. Now, here in the United Kingdom, bank news is easily the largest focus of investor attention today. HSBC delivering full-year results for 2012. Their profit dipped by about 6% to $20.6 billion US dollars. They had to take about a $5.2 billion charge against the rising value of its own debt, similar accounting machination that has afflicted all of the major banks around the world for this earnings season. But more significantly, the fines that the bank had to pay with respect to money laundering in the United States and the compensation here in the United Kingdom for customers missold payment protection insurance allowed the bottom line to drift to that degree by about 6%. Now, the bank tried to lift its dividend by about 10% to placate investor concern, but I think crucially the fact that the return on equity, return on equity returns for shareholders, a key measure of performance, that slipped to 8.4% from a little bit more than 10% last year. And even though the bank is buttressing its finances, investors didn't like what they saw, and they took down the stock to the tune of about 3% so far this morning. The bonus payments underneath that also make for interesting reading. CEO Stuart Gulliver is going to make about $7.5 billion for the whole of 2012. That includes a £2 million bonus, but crucially, 5 of the bank's top non-executive members, otherwise known as the traders in the organization, are going to make a combined 27 million sterling. That's 5 people, 27 million sterling. It's not going to make for good reading for any of the bank's investors, indeed, or the Vox Populi around the United Kingdom, which are growing increasingly concerned about the high levels of compensation at some of the biggest banks that, of course, taxpayers have underpinned either explicitly or implicitly. That was given new life today when the Bank of England told us that their key funding for lending scheme, a way in which banks can draw down cheap funds as long as they lend them into the real economy, is showing no signs of success at this stage. In its 6-month tenure, banks have drawn down about 13.8 billion sterling from the scheme, and they have actually decreased their net lending by 1.5 billion sterling. In the last 3 months of last year alone, they drew down 9.5 billion, and they decreased their lending by 2.5 billion. This is an absolutely abysmal figure, and in my view, does suggest that the Bank of England may need to do something a little bit more radical when it meets on Thursday after its 2-day interest rate decision meeting. Now, some analysts say that that funding for lending scheme had replaced quantitative easing as the bank's key monetary policy tool. If it's failing, investors now may feel that the bank will either have to cut the borrowing rate, which sits at a record low 0.5%, increase quantitative easing, which has sat at $375 billion for a number of months, or do something even more extraordinary. We'll have to wait and see, but right now investors aren't taking any chances. They're marking down sterling. It's around 150 against the US dollar. That's a 2.5-year low, and they're buying UK gilts, pushing the yield down to 1.87%. You'll remember just after the Moody's downgrade 2 weeks ago, 10-year yields were trading at around 2.18%. So it's been an extraordinary rally, not because people are confident in the UK economy, but actually the opposite. They're so not confident that they feel the Bank of England is going to have to step in and buy more. Follow all these stories, please, on the economy page at the IB Times UK. We'll see you tomorrow.